Hi, Assalamualaikum. My name is NURUL SHAFIQAH.
My name is Nur Aisyah.
My name is IZZYAN.
My name is ASYRAF AZLAN, and I would like to present my video assignment on the topic financial ratio analysis. First of all, let me explain the company background.
MOHD Engineering Berhad is well-established machine engineering and construction company, founded in 1972. Headquartered in Selangor, the company is widely recognized for its capability in civil engineering, marine construction, infrastructure works, and industrial facility. MOHD operates both locally and internationally with a strong presence across Asia, the Middle East, Africa, and Australia. The company serves a diverse range of sectors, including aviation, oil and gas, port, and manufacturing. From a financial standpoint, MOHD Engineering is a public listed company on the main market of Bursa Malaysia. Despite facing challenges in the construction sector in recent years, the company maintains a diversified revenue base and continues to secure major local and overseas projects. It also benefits financially from its associate stake in Cambodian Airport, providing a steady stream of recurring income. MOHD places strong emphasis on financial sustainability, strategic partnership, and long-term growth, backed by a solid track record and sound corporate governance.
ZAINI Berhad is a Malaysian-based company listed on the main market of Bursa Malaysia, primarily engaged in engineering and construction, property development, and asset and facilities management. Originally a civil engineering and construction arm under the MMC Corporation Berhad, ZAINI evolved into a standalone public listed entity with a strong track record in delivering major infrastructure projects both locally and internationally. Over the years, ZAINI has been involved in various high-profile developments including power plants, highways, and commercial buildings across Malaysia, Indonesia, and the Middle East. The company emphasized its expertise in turnkey engineering, procurement, construction, and commissioning projects, supported by a team of experienced professionals and technical partners. Despite its achievements, ZAINI Berhad faced significant financial challenge in recent years. In May 2023, it was classified as a Practice Note 17 company by Bursa Malaysia after its auditors issued a disclaimer of opinion due to material uncertainties and unreconciled balance in its financial statements. This status reflects the company's financial distress and obliges it to submit a regulation plan to restore its financial health and maintain its listing status.
JM Corporation Berhad is one of Malaysia's leading conglomerates with a strong presence in construction, property development, industry, infrastructure, and plantation. Established in 1983 through the merger of several construction companies, IJM has grown into a diversified group with operation in over 10 countries, renowned for its commitment to quality, innovation, and sustainability. IJM continues to play a key role in shaping Malaysia's development while expanding its footprint across emerging markets.
Gamuda Berhad is one of Malaysia's leading engineering, construction, and infrastructure companies listed on the main market of Bursa Malaysia. Established in 1976, the company has built a solid reputation for delivering world-class infrastructure and property development projects across Malaysia and international market. Gamuda is best known for its large-scale civil engineering works, including highways, railways, water supply scheme, and underground infrastructure. Over the years, Gamuda has pioneered many of Malaysia's major infrastructure development, including the Smart Tunnel, Klang Valley MRT lines, and major expressways such as Lebuh Raya Damansara Puchong (LDP) and the Shah Alam Expressway Kesas. And the core business segment include such as engineering and construction, property development, infrastructure concession, investment, and development venture.
Liquidity ratios measure a company's ability to meet short-term obligations. The current ratio and quick ratio are two key indicators that show how easily a company can convert assets into cash to pay its debts. Leverage ratios evaluate the extent to which a company relies on debt financing. The debt-to-equity ratio and interest coverage ratio help assess the financial risk and long-term solvency of the company. Activity ratios focus on operational efficiency, showing how effectively a company uses its assets. Ratios like inventory turnover and receivables turnover reflect how quickly inventory is sold and how efficiently receivables are collected. Profitable ratios indicate a company's ability to generate profit. Gross profit margin, net profit margin, return on assets (ROA), and return on equity (ROE) are commonly used to assess the company's earnings, performance, and financial success. Market ratios provide insight into investor perception and market valuation. Key ratios such as earning per share, price earning ratio, and dividend yield help investors evaluate stock performance and growth potential.
I will explain about liquidity ratio. So liquidity performance of four company, which is Muhibah Engineering Berhad, MEB, ZAINI Berhad, IJM Corporation Berhad, and Gamuda Berhad over the years 2022 to 2024. Liquidity refers to a company's abilities to meet its short-term obligation, and it is commonly measured using the current ratio, quick ratio, and net working capital (NWC). MEB show good improvement. Its current and quick ratio increase each year, indicating stronger ability to pay short-term debt by 2024. ZAINI Berhad performed poorly across all years. Its ratio stayed below 1.0, and it has negative working capital, showing high financial risk. IJM maintains strong liquidity every year with current and quick ratio above 2.0 and increasing working capital. It shows excellent financial stability. Gamuda had the best liquidity overall. Its ratio improved yearly, and it has the highest working capital, showing it is very well positioned financially. In conclusion, both IJM and Gamuda have shown excellent and stable liquidity, making them financially strong companies. MEB start off weak but improved steadily, and it's now in good shape. In contrast, ZAINI Berhad remain in poor financial condition with weak liquidity through the 3 years. This comparison help highlight which companies are better positioned to handle short-term financial challenges.
Leverage ratios of four companies, MEB, ZAINI Berhad, IJM Corporation, and Gamuda Berhad across 3 years from 2022 to 2024. Leverage ratios measure how much a company relies on debt to finance its operations. The two key ratios are debt ratio, which is percentage of total assets financed by debt, and debt to equity ratio, which is comparison of total debt to shareholders' equity. The higher value means greater financial risk. MEB had stable and moderate debt levels, with a debt ratio around 47 to 48% and debt to equity around 89 to 92%. This shows a balanced use of debt and equity. ZAINI Berhad had very high leverage in 2022. Debt to equity is 599% and negative equity in 2024, which is negative 4.01%, indicating serious financial trouble and high risk. IJM maintained the lowest debt levels with a debt ratio around 41% and debt to equity near 55%. It had the strongest and safest financial structure. Gamuda had a high debt ratio of 100% in all years, meaning all its assets were financed by debt. Its debt to equity remained above 180%, showing high financial risk. In summary, IJM Corporation had the strongest leverage position with low and stable ratios, while MEB maintained moderate and well-managed debt. ZAINI Berhad showed serious financial trouble, especially in 2024 with negative equity. Gamuda carried high financial risk due to being fully debt financed. These differences reflect each company's approach to managing financial risk.
Now, I will share about how efficiently MEB, ZAINI Berhad, IJM, and Gamuda use their asset from 2022 to 2024 using activity ratio. MEB show the best improvement. Its receivable and inventory turnover increased each year, and it used its asset more efficiently by 2024. ZAINI Berhad had the weakest performance. Its turnover ratios were very low and even dropped to zero in some area by 2024, showing poor efficiency. IJM maintained strong and stable efficiency. Its turnover ratio were consistently good, showing effective use of asset. Next, for Gamuda performed poorly. Its activity ratio remained low or zero, suggesting weak operation and poor asset use. Overall, MEB showed the most improvement and become highly efficient by 2024. IJM maintained strong performance with consistently good asset usage. In contrast, ZAINI Berhad and Gamuda Berhad demonstrated weak efficiency with poor turnover ratios across all categories, pointing to possible operational inefficiencies or management challenges.
Now, I will summarize the profitability performance of four companies over 3 years based on gross profit margin (GPM), operating profit margin (OPM), and operating ratio. MEB shows stable but modest profitability with slight improvement in GPM and OPM in 2023, followed by a small decline in 2024 its operating ratio increased slightly, indicating rising operational costs. ZAINI Berhad recorded the highest GPM and OPM in 2022 and 2023. In 2024, it saw an extreme spike in OPM around 583.49% and operating ratio around 555.25%, suggesting either an exceptional gain or irregularity. IJM displayed consistent performance with improving GPM and declining operational ratio over time, indicating strong cost control and operational efficiency. Gamuda maintained good profitability, peaking in 2023. However, its operating ratio rose in 2024, signaling increased cost or lower efficiency. So, among the four companies, ZAINI Berhad stand out for its exceptionally high profit margin, particularly in 2024. However, the enormous spike in figures warrant further investigation for accuracy. IGM showed the most consistent improvement in operational efficiency as seen in the declining operation ratio. Gamuda maintained a strong profit margin but showed signs of increasing cost in 2022. MEB remained relatively stable but did not show significant improvement across the period. Overall, while each company demonstrated strengths in different areas, IJM appears to be the most stable performer in terms of maintaining profitability and improving cost efficiency over time. Thank you.
Next, I will share about a comparative market performance analysis of four companies over the past 3 years, which is Muhibah Engineering, ZAINI Berhad, IJM Corporation, and Gamuda Berhad. We look at 5 key metrics, which is earning per share, dividend payout ratio, book value for share, and the price to earning ratio. Starting with Muhibah. Muhibah demonstrated exceptional earning growth with its EPS surging from 1.34 to 33.47 over the period. It also maintained generous dividend payout. However, its PE ratio remains surprisingly low, suggesting the market may be undervaluing the company despite its strong financial performance. Next is ZAINI Berhad. ZAINI EPS remained flat at around 0.50, showing little no growth, yet it continued to pay high out dividend, resulting in a dividend payout ratio of over 500% by 2024. This indicates a payout strategy that is not financially sustainable in the long run. Moving on to IJM. IJM recorded steady and consistent earning growth with EPS rising to 131.30. Dividend was stable and overall fundamental look strong. Still like Muhibah Engineering, IJM is also undervalued, reflected in its very low PE ratio of around 0.13. This suggests that investor sentiment may not yet be aligned with its actual performance. Last but not least is Gamuda. Gamuda earnings remain relatively modest but have shown a positive upward trend. It continued to deliver consistent dividend throughout the year. Interestingly, it holds a high PE ratio of 7.99 as of 2024, signaling strong investor interest, possibly driven by future growth potential or strategic development, despite its lower current earnings. In a summary, Muhibah and IJM both showing strong fundamental and robust earning growth, yet the market seems to be undervaluing them. While ZAINI Berhad is facing sustainability concern with flat earning but unsustainably high dividend. Meanwhile, Gamuda enjoy high market confidence even though its profits are still catching up.
Financial ratios provide valuable insight into its overall performance, stability, and growth potential. Profitability ratios such as gross and operating profit margins reveal how efficiently a company generates earnings. While market ratio like earnings per share and price earnings ratio reflect investor confidence and market valuation. A strong company will typically show consistent growth in earnings, efficient cost management, and sustainable dividend payouts. However, unusually high or low ratio may signal potential risk or evaluation. Overall, financial ratios are essential tools for evaluating a company's financial health and guiding sound investment decision. Thank you.